Hey there, Lincoln here from bullacademy.org. Today I have Tyler Okland with us. We're going to talk about Opendoor and their amazing earnings for Q1 of 2022, their first profitable quarter, which was huge. And we're going to talk about whether or not they can sustain this and where they go from here. And of course, talk about Tyler Oakland's new Data Door tool that will show you live or recent data on Opendoor's activities in the market, such as buying, how many homes they're buying, and more about the financials behind those purchases and deals that they're doing before the reports are out, the quarter reports are out. So this tool is going to be amazing for everyone who's invested in Opendoor or is interested in learning more about the tool, about the company. So I am very excited to hear more about Ditador and just motivations behind it from Tyler and what he sees for his future and what he might add to it to make it more useful for investors who want to learn more about Opendoor before Opendoor reports every 3 months or so. So I would love for Tyler to introduce himself and tell us about Opendoor, just a brief summary of what Opendoor is and his thesis, and then we dive into their Q1 earnings.
Yeah, thanks for having me on again, Lincoln. My name is Tyler Okland. I am a physician in the Bay Area, but I'm passionate about investing, and there's a few stocks that I follow quite closely. I read a Substack called The Operator, and over the past year, I've become increasingly convicted on a particular stock called Opendoor, which is a real estate technology company, and their whole value proposition is that they find a way to make what used to be this Byzantine, very painful process of buying and selling a house, something that's actually a delight. And so I'm really bullish on the long-term opportunity for this company. In regards to Datador, that's been this really fun sort of project that me and some people who are also interested in the company have been able to build over the past 3 months, and it's allowed us to gain much more confidence in the opportunity ahead for Opendoor because we're able to see their transactions and their operational execution in real time. And so 2 weeks ago, we launched the dashboard, the free dashboard, which everyone can look at and sort of get a sense directionally of how Opendoor is doing. So things like sales, listings, gross profit margin, which markets are performing best. And then as time goes on, we have a really long roadmap and pipeline of products that we're going to continue adding into it to make it sort of the town square for content for Opendoor.
That's awesome. And again, it's amazing what you've done with this community that you're building on Twitter with Opendoor. And just in the last year, learning about all that company is doing and your motivation for helping other investors is peer, right? You go out there, you do your own research. Now you're a surgeon, right, in training, and in your free time you go out, you do the research, you find data, and you synthesize it for all of us to look into. And now you have this tool called Datador that you just explained will be able to provide more data to investors. So today I want to talk about just how accurate that data was for investors. Before the earnings, you released some estimates for Opendoor's Q1 2022 earnings report, right? And what you thought that the company is going to do, how many homes they're going to sell, revenues estimates, profitability, and so much more data, which is very impressive that it actually turned out to be very, very close to the actual numbers, right? Some were a little bit over, some were a little bit under, but for investors, they were able to see what the company was going to do ahead of the actual report. And I would love to hear more about how you got that data, how you, if you want to share that IP, and how you go about actually creating that kind of report that was so accurate.
So my partner Sebastian is a software developer, and he's really the genius behind the data collection. And what he's been able to build. And basically what he's doing is he's collecting public data. So none of it is private or anything like that. Public data from websites like opendoor.com, zillow.com, and public county registries. And basically scraping all of those data so that we can make estimates that are accurate and in a timely fashion. For Q1, we captured 94% of home transactions, which I think is pretty powerful, considering that 6 to 15% of Opendoor sales are actually off balance sheet. So I think we're getting very close to being as accurate as possible. But when you look at our estimates versus consensus, they weren't even close, right? Our estimate seemed outlandish and crazy compared to the consensus
Mhm.
estimates by 8 Wall Street analysts, which we posted on our site a few days ago. But actually, all of our estimates were single-digit percentage points away from actual results, which I think is a great start.
Yes. So, like you said, analysts were reporting very conservatively. You actually stuck your head out there and said, "Hey, we actually believe we're going to do better. Openers going to do better than analysts believe, right?" And it turned out that you were very close, right? Pretty much correct. So, can you walk me through those numbers, the Q1 2022 numbers, and just important points that you took away from it, which ones stuck out to you and what they mean for the future of the company?
Yeah, so I think sort of from a 30,000 foot view, the big number was revenue, right? So revenue came in at just about 5.2 billion, which is 590% up year over year, which
Mhm,
is great, right? But then the big upside surprise was actually that Opendoor was profitable. So it was the first profitable quarter. They managed 99 million of adjusted net income and 28 million of net income for the quarter, which is really great
yeah,
when given the number of people out there who say this model will never work, it'll never be profitable, and how much money Opendoor lost last year. I think it's nice to kind of be able to point to this and say, hey, the model seems to be working. And so their gross profit margin sort of split our estimates. It was actually around like 9.9%, although the range was 9.9 to 10.4%. Fantastic gross profit,
mhm.
doubled sequentially. And then adjusted EBITDA was at the high end of our range at 176 million, I believe, which is really, I mean, they're really starting to be a money printing factory if they can continue these trends.
Yeah, I'm still shocked by because I'm not as into the numbers as you are when it comes to seeing what they are before they actually report it. So I wasn't because the analysts were predicting that they're gonna lose, what was it, 6 cents per share or something like that?
Hmm.
But it came out to 28 what was it, 15 cents per share that they actually netted?
That's a good question. I don't know the EPS off the top of my head,
Yeah,
but I
yeah,
know.
I think it was 15. Yeah, they reported 15 cents in earnings per share against expected estimates of negative 6 cents per share. That's amazing.
Yeah, I think basically we're at the point now where using the Wall Street analyst expectations for Open Doors numbers has never been an accurate practice.
Mm,
And I think a part of it, I think there's several components to this. One is just like the business model is misunderstood, and so it's hard. There's no playbook, right? Like if you're a car company, analysts know how to analyze a car company. Maybe Tesla isn't a good example, but just I'm saying like there's a playbook that these analysts can use to
mhm.
derive their estimates. Whereas Opendoor is such a unique company, as a real estate, as a technology, it's really hard to know. And so these analysts come out and they say, we had one of our interns look at 100 home transactions, and here's what those data say. There's no ability for them, unless they're using products like Datador or resources like us on Twitter, to inform those estimates. And I think over time, people are going to sort of say, hey, these consensus estimates are probably not nutritional to the soul to use for actual performance.
Yeah, and just to make your point very clear, that was a 338% shock, right? Surprise, right? And they've beaten everyone. So maybe that speaks to management that they are giving conservative estimates or guidance to analysts, and then they come out and just crush them.
Yeah, I think they're a very conservative company at baseline, but also with any of these technology companies when they first go public, especially when they get a new CFO, like the playbook rule number one is under promise and over deliver. Like the last thing those CFOs want to do in their first few quarters as a publicly traded company is lose all credibility with the
Mhm.
market. And so I think Kerry Wheeler has been very conservative about her estimates, and we can see that with the revenue. There have been some misses on the EPS side, but I really think that that's just more due to scaling, experimentation, and some really crazy real estate dynamics in 2021.
I'm still stuck on this 15 cents per share. Can you walk me through how we get there? How many houses were sold? What services were put on top of those houses, attached to those houses, those sales, right? And or financing that was offered. How do we get to becoming this profitable so quickly? This is big news.
Yeah, no, I agree. It's fantastic. One of the metrics that I've been kind of working on myself in terms of how I think about Opendoor is what I've been calling the delta. And so for me, the delta is the difference between gross profit margin and net income. And when you look throughout 2021, that delta was as high as like 50%, right? So 5,000 basis points. And every quarter since, it's been shrinking that delta. And the reason that this number is important is because it tells you the minimum gross profit margin that Opendoor needs to be a profitable company. And I think the bigger Opendoor gets and the more economies of scale that it's able to layer in, the better operational efficiencies that it's been, the structural operational efficiencies that it's been able to engender. All of those things are going to create this company with a really low delta. And so I'm talking like a single digit, like 6% delta, so that, even at a gross profit margin of 7%, Opendoor could be a very profitable company. And remember, their fee is 5%. That's fixed. And so you really only need a couple hundred basis points if you can get to a delta that's low enough. And in this first quarter, Opendoor got to a delta of, I think, 9.6%, which is fantastic. If they can maintain that, that means that anytime we see a gross profit number print of 10% or higher, we're going to keep printing money.
Yeah. So this gross profit you say is the main number to be looking at here, and I want to just dive into a little bit more of why the gross profit is the important thing to be looking at, and how does that boil down to the bottom line?
So basically, when you start with gross profit, if you want to get to contribution profit, you have to subtract selling and holding costs. And the selling cost is something that I think we're going to continue to see a lot of downward pressure on over the years as Opendoor continues to aggregate unique supply and demand follows. And so when you sell a home, generally you're paying 250 basis points to the agent, right? And so Opendoor, their current selling costs, or at least as of Q4, I haven't seen them for Q1 yet, but for the past couple quarters, it's been around 2.6%. But with Opendoor exclusives, and as Opendoor increasingly is able to disintermediate the realtor in the process, that selling cost should drop to below 2%. And that'll be a big uplift for overall contribution profit and net income profitability. In terms of the attach of, uh, of other ancillary services, it's still a very small percentage of overall gross profitability. Even with title and escrow, where the attach rate is 85%, it's not in all of their markets.
Hmm.
So they're scaling into that, although it's about $2,500 worth of additional high margin revenue. When you think about how much they're selling homes for at this point, it's a pretty small percentage of overall profitability. But I think once that's added to mortgage and homeowners insurance, home warranty, moving services, once we blend all of that into every home transaction, we'll see persistently elevated gross profit margins.
Yeah. And I'm looking at numbers right now, and that's something I want to talk about with the ancillary services and title escrow, home loans, buy with open door, right financing. I'm looking at this, and they're doing 2,500, like you said, on title and escrow. They recently launched home loans. They're saying 5,000 contribution profits. Buy with open door, and that's at 7,000. Home warranty upgrades, models, home insurance, 7,500. Right, that's all I'm looking at all of these things, I'm sure you are too, and we have here this graph. Can you walk me through what this first proof point, open door title and escrow is? What is this telling us about the opportunity to use all these ancillary services to build on more profits and more contribution margins for the business? How do these contribute to the bottom line, pretty much?
Yeah, so this is really the long tail opportunity for Opendoor, and this goes back to sort of one of my fundamental core beliefs of why Opendoor will outperform for the long term. And so the reason is because when you look at the home transaction experience, there are upwards of six parties that you have to work with and pay services to just to buy a home or sell a home,
Mhm.
right? And the problem with that, the problem with using six different services is they're all charging you their customer acquisition cost. So you're paying customer acquisition cost six times. And
Yeah.
so as a result, all of these different services, so title and escrow, mortgage, homeowners insurance, all these other things are much more expensive than they need to be for a company to profitably provide them. And so if one company could come in, own the transaction, and so as a result, lead their customer through all of these different ancillary services. They don't have to
Mhm.
re-put in their information. They don't have to repay for customer acquisition cost. The customer could actually pay less, and yet Opendoor would still be more profitable than their competitors because they've already got them in the system, right?
Yep.
They acquire that customer for free. And so not only is the customer getting great value, but you have this incredibly profitable company behind the scenes. And so it's a better experience for the customers. They're paying less money, and Opendoor in such a situation would be crushing it. The problem today is that Opendoor has this laser focus on the seller ecosystem, right? Opendoor's product is a tool for sellers to sell their home. But to actually get all of these ancillary services, you need to own the buy side of the transaction. Because if you're selling your home, you don't need a mortgage, right? If you're selling your home, you don't need a home loan, you don't need a home warranty, you don't need homeowners insurance. Like, you're selling it, right? So it's relevant. But as Opendoor increasingly redefines the buying experience, that's when it can really layer in all these additional services. And this is like the long-term thesis because all of these additional services are super high margin and they're so
Mhm.
easy to attach and they don't cost anything more. Take, for example, something like home warranty, for example, right? Like Opendoor already does property management. Like that's one of their core competencies is property management. So if Opendoor was able to do things like home warranty, they already have the infrastructure to service a home, and they already have all the data about the home, so they know what the underwriting risk is. And that same goes for mortgage, same goes for homeowners insurance. They just have this massive advantage behind the scenes to offer all of these services at a cheaper and yet more profitable fee.
Yeah. And that's a good point. And like you said, there are all these services, they all cost a lot to actually operate, right? If you can bring it all under one house, vertically integrate, horizontally expand, you get to offer it at better margins and with a more seamless process, right? And that's how Open Door gets to a net promoter score of 80, greater than 80, which is like this whole report was amazing, right? It's like just numbers after numbers. It's like this is so impressive.
Yeah,
80%, 80 net promoter score is very good, right? So a tech company that most there's many companies out there that people say we love, like Apple and Google and Comcast and whatnot. They're just so sewn into our cultural fabric, but they don't have as good as net promoter scores as they should because people get upset at the small things that they do wrong, right? And sometimes they do big things wrong. Bad customer service, the cost of even just getting a repair for something that's broken with Apple, right? Apple has pretty bad repair costs, but with Open Door, people are loving what they're doing, even though some people say, "Oh, Open Door is putting real estate agents out of business, or they're not paying home sellers as much as they could actually get on the open market." Why do people love Open Doors so much despite all of those things that people say, right? Why is that? You've already touched on it with just the streamlining of their process, but why is Open Doors so beloved?
I think a part of it, so there's two contributing factors. On the one hand, it's like Opendoor's product is just great, and it was built with intention and love and a lot of thoughtfulness. But the other aspect of it is that the traditional offering, which is their competition, fundamentally, is so broken. So it's those two things that are really contributing to the super high net promoter score because it's an experience that people sort of go into expecting to hate. They expect it to be stressful and opaque and complex. And so when Opendoor comes in and cuts through the clutter and says, no, like, here, you're going to meet Dave. Dave's going to walk you through this whole process. You can sit on your couch, just send us videos or pictures of your house. We'll give you this initial offer. We'll send an inspector. They'll do their inspection. We can have your money in your bank account within a week or two. At this point, or at least at some point in the future, I think it would be crazy if every home buyer didn't start their journey, or home seller, home buyer start their journey with an offer from Opendoor, right? Like there's no reason not to. It's the same thing as Carvana.
Mhm.
or if you're trying to sell your car, like, why not start with an offer? It's free, right? Like,
Mhm.
there's no appraisal fee or anything like that. Like, information is power. Just start with, can I get a bid on this item and see what people think it's worth. And if I don't like it, fine. I don't have to use that service. I can try my luck in the open market or through another service. But like, the reason that Opendoor has succeeded is because it's so difficult to buy and sell a home in an offline process. And as we march increasingly towards this digital future, people are going to demand a digital solution. And there's only one company that has a net promoter score greater than 80 who is innovating the entire real estate transaction stack, and that's Opendoor.
And to your point about Carvana, I actually just bought a car with Carvana. It went great, right?
Yeah.
I started there. I bought it in my bed on one Sunday morning, right? I woke up and said, "Today's the day. Let me just buy a car." With all that said, we love Open Door on the seller side, and you spoke to this earlier that Open Door isn't quite on the buyer side. Like they're not penetrating as much as they could yet, right? Right now, when I like you said, start with Open Door, start with Carvana. But right now, when people go to buy a house, they don't really think Open Door. They just think Zillow, right? Or
Mhm.
Redfin. How does Open Door get itself in that conversation? How does Open Door get on top of those search intentions?
One of the questions I get a lot is, what sort of market ownership or inventory ownership does Opendoor need to get to the point where it holds enough supply that its buyer offering has a higher value proposition? And I actually don't think it's a specific number. I think it's not how much, but actually what it's holding. And so by that I mean, Opendoor doesn't need to hold 10% of every home in every market, right? What Opendoor needs to hold is the best home in every neighborhood. That's the secret sauce, right? And so initiatives like Open Door Exclusives, which is being built by the Wildfire team, which was acquired by Open Door in 2021. Open Door Exclusives is this really interesting take on supply and demand dynamics. And so what they're doing with the Open Door Exclusives is they're buying, or they're taking those homes that they think are the best in a neighborhood that are going to sell really fast, and they're listing them only with Open Door. So you can't use a realtor, right?
Mm,
And so as a result, Opendoor doesn't have to pay 250 basis points to a realtor when someone buys the home. And so it's this super cool process where it's all these unique homes. They're starting only in Texas, right? So they only have 2 markets in Texas right now where they're doing this. But the whole premise is, if you can sell more homes through Opendoor Exclusives, not only do you aggregate unique supply, and so when you're going around looking at houses with your realtor and you're like, hey, what about that one at the end of the street? That's the
mhm.
nicest house. And the realtor says, I actually can't show that one to you. And they're like, well, why not? And now you have an awkward situation with the realtor, and the person's going to go there themselves, right? So that's really powerful. But the other aspect is we can decrease those selling costs as well. So it's a much more profitable sale for Open Door.
Wow. I That's my first time hearing of this, and it's smiling so much because that's a big deal. That's like the Netflix model,
Yep.
right? Or any streaming at
Airbnb,
this point.
Netflix.
Now you have to know about me. You have to care, right? Because I have the show you want to watch,
Yep.
right? I have the whatever the newest big name on Netflix is. You have to come on my site to see it. Euphoria on HBO. You have to come here to watch this. So now with Open Door, like you said, even if you've never heard of Open Door, but you want that nicest house, now you heard about it, and now you have to care about Open Door,
Right.
right? And so now you're gonna tell your friends, "Hey, have you heard of Open Door? What's going on here? What's I want to buy this house. They have it. Are they legit? Are they legitimate?" And eventually, your friends will say, "Yeah, I've heard of them, and they sell great houses, right?" So yeah, that's very powerful. I actually never thought of it that way. That you don't need to own a huge percentage of the market to be known or to be relevant. You can just own some of the best, or a good percentage of the best, and be in a conversation. And eventually people start to say, okay, I'm gonna start on Open Door. I'm gonna look at what they have before I go to Zillow or before I go to Redfin, right?
Right. I mean, yeah, to your point, it's like, if I'm a streaming service and I own The Office, Game of Thrones, and Friends, I don't need to own anything else. You know what I mean? That's the point, is you can have all this shit content, and say like, oh, we have all of these homes in inventory, or this all these shows that nobody wants to watch, or you just have the best in breed, right? The premium content that everyone will pay to go see. And so I think I think like this is a really important part to understand and internalize about their strategy.
And best yet, just to build onto that, we could add in the mall model, right? As a shopping mall. They put the anchor stores at the end, right? They got the JC Penney's, they got the what is it, Nordstrom's at the end. You have to go to that mall to get to those stores. And so they might not need to have all the stores, but they can have some of the stores, a good amount of the stores that aren't the best. But as long as they have the JC Penney's and the Marshall and the Nordstrom's, you'll come through and look at all the other stores. And so with Opendoor, if I have the best house on the block and I have some other houses along the way, you might not be able to afford or care about the best house, but you'll look at the smaller houses, right? And then you might buy those. And
Hmm.
so now you lift up all the other houses. That's multiple models on top of what Opendoor is already doing, and I think that's actually very powerful. You
Yeah,
got the you
agreed.
got the Netflix streaming model, you got the mall model, and they've all worked out to an extent, right?
Yeah, I mean, on Datador, we're seeing currently, and I mean, it's early days, right? So just educating the consumer is a headwind for a product that's as new as something called Opendoor exclusives, much less Opendoor as a business itself. But
Mhm,
on Datador, we're already seeing 5% of Opendoor exclusive homes going to pending within 2 weeks of listing. So again, it's not just that the selling price is going down, right? Because you don't have to pay the
mhm,
realtor. These are also homes that sell super fast.
mhm.
And so holding costs, interest fees, those are all lower, and all the revenue made on the resale gets to be pushed back into the iBuying engine.
Last time we discussed Opendoor on our previous video with you, we discussed your overall vision for the company, and I was pretty impressed with how you thought about this holistically and how we might be able to get to the point where Opendoor is pretty much owning the entire process of both buying a house and then selling a house, and how that can be used to give Opendoor its ecosystem, much like an Apple, where you have a single product that they can control and make the best for the consumer, and the consumer loves them for that because now they have a premium product, right? And so with Opendoor, we can get to a similar point where you can get a house that it goes through Opendoor's entire life cycle of being bought and sold and held and maintained through Opendoor. So I would love to hear about your vision for all of that, the Opendoor home, right? Can you walk us through that? And before we get into it, just what this quarter, this specific quarter, Q1, and the net income, net profit means for actually getting to that eventually, right?
Yeah, so I would say that there's two verticals that I'm really interested in long term for Opendoor. One is sort of the entire transaction stack, which is what we mentioned earlier. So it's still really early days for that, but that's the core transaction for Opendoor. So because they own buying and selling a home, they can layer in things like title and escrow, mortgage, homeowners insurance, renovations, home warranty, and moving services, right? So that's a big fat stack of probably, I don't know, $20,000 to $30,000 of ancillary income per home if they attach all of them. That's the transaction stack. Opendoor Home is a little bit different, and I've made the argument that even with all of that attached, if your business is selling to a customer and the customer only buys one product every 7 to 12 years, which is what Opendoor's current model is, it's not a great model, right? Because
Mhm,
you're spending a lot to acquire that customer. Ideally, you're in a situation where that customer keeps coming back or continues to pay for a product over time, right? And so, how do we go from Opendoor being this one-off, infrequent, once a decade transaction business into a business that forms multi-decade relationships with customers? And so that's really where the Opendoor Home concept came
mhm,
from. And the premise there is, can you make owning and maintaining a home into a product? And I think that there's a lot of creative ways that Opendoor can leverage its technology to do that. And so Opendoor Max, which is sort of a valuation in real time of your home using Opendoor's automated valuation model, which is currently in its early stages of its life cycle. But if as a homeowner you can see in real time what your home is worth, and that's backed by an Opendoor backed offer, that's really powerful because you know how much equity you have in the house and how much you would get if you sold. You're always near to liquidity in that situation. I think that's
mhm.
really powerful for your largest asset. So that's a part of it. But then there's things like landscaping, yard maintenance, cleaning, handyman as a service, renovations, interior design, all of these little verticals that can be added into either a subscription product or a one-off product to help make the maintenance of your home both easier and ostensibly cheaper. I think those are sort of the ideas to think about long term. And because Opendoor is a property management company at heart, I think it has a unique opportunity to build a vendor system that can be filled at a much higher level and more easily for customers. The last thing I would say is the opportunities for home technology, for smart home technology, are immense. And I think as time goes on, Opendoor has shown that it has the capacity, to be both boots on the ground and software. And that's a really interesting blend of engineering talent at the company. So I think that they're uniquely positioned to really capitalize on smart home technology trends as well.
When I was listening to you, something that stuck out to me was when you're talking about the Opendoor Max and how that allows for liquidity, much like the stock market. Of course, not as quickly, but you have the opportunity to see what your home is valued at from week to week or maybe even day to day, and now you can tap into it. But on the open door side, and again, that's great for the customer, right? Can't wipe over that too quickly. But for open door, that's even better for them too, because if they're the ones maintaining this house and they keep it in their ecosystem, they keep it in their whole flow. Now they know how this house is being maintained, right? And they can now estimate how much it's going to cost to flip it, right? Or to not flip it, but to turn it over for another owner, right? And that, of course, adds to the ability to grow their profits because now they can be more efficient with their process of uh, preparing a house to be sold. And I'm not even sure if they're interested in rentals, but something that could come down the road if they were to think about that. So this open door home concept doesn't only help the homeowner, but it also helps open door with their efficiency, and of course, like you said, they're now able to offer a much better service across the board and become more profitable.
I think one of the use cases that I've explained in the past to think about how the flywheels of these transaction services and open door home services interact and compound. Like, say, for example, you bought a home with Open Door, right? And because the process was so easy and because the prices were so good, the value was so clear, you decided to do your mortgage, your title and escrow, your homeowner's
Mhm.
insurance, and your warranty through Open Door. That's great, right? But if we think about the long term opportunity is 6 months later, Open Door says, hey, your roof is actually approaching a time when it probably needs to be repaired or replaced,
Mhm.
right? Here's our bid for what that would cost. You go through the process with them, they find you a vendor, they replace the roof. Next day you get an email from Open Door, they say, congratulations, you just replaced your roof, so now you get a new roof premium through your homeowner's insurance through us,
Mm.
right? And so there's all of these different ways that you can create this fantastic customer experience that no company has been able to unlock because they don't have Open Door scale or product
Mhm.
roadmap. But when you start thinking about how these strategies can combine in this compelling way for both the consumer and from a profitability perspective, there's no company like it.
Yeah, and we talk about all these things like they're great, but someone listening from the outside who's not really into the data like this and into the company might think, "Oh, you guys are being big brain or very idealistic, right? It's too far out there, right? It's 10 years in the future, 100 years in the future. You can't get there." But what you just said about the home mortgage discount, something that SoFi is doing today, right? SoFi with their not specifically home mortgage, but with their credit card, they're just something that people that other banks don't do, where they will say, "Hey, if you consistently pay down your credit card debt, we'll decrease your what's it called? Your interest rate, your APR, right? APY, whatever it is, right? And we'll even give you cash back or in points so that you can redeem it in our app." And because they own the entire ecosystem, the entire process of money management, right, where you bank and buy stocks and cryptos and all that other stuff, they benefit from giving you those discounts because now you're going to just spend it back into their ecosystem. You're going to go invest it with SoFi money or SoFi Invest, right? You're going to save it. You're going to buy cryptos, and even maybe even save for a house. What you're saying over the door is it might seem like it's too far in the future, but these are things that as you integrate vertically and horizontally scale, you get closer to incrementally, right? And eventually you get there, and people are like, "How is this even possible?" Right? And now Open Door is doing it, and the rest of the market has to catch up. And now we can even look at it now with Zillow. When Open Door started, everyone was like, iBuying's not going to work. And then it starts to look like it might work. And so Zillow hops in and they think, oh, we can do it too, since those guys can do it. No, you can't, because you don't have the record. You don't know what you're doing. We've been doing this. We've been working our way up to this point where now we're at 15 cents in net income per share, while you just shut down your whole iBuying operation because you were losing too much money because you didn't have the right data. Tell me more about just why Open Door works when Zillow could not, right? How is it possible that this small company is able to compete, or even not even compete, but just completely crush a company like Zillow, right? Who owns the name of buying a house? You want to buy a house, you go to Zillow.com, right? That's what you do. And then Open Door comes in and says, "Hey, we're the iBuying king. You can't compete with us, right? How is that possible?"
So the first article I ever wrote about a company was about Opendoor in June of 2021, and I compared Zillow versus Opendoor because at the time everyone was sort of saying Zillow is going to eat Opendoor's lunch. And one of the arguments I made at that time in that article was Zillow is a high margin search company, right? It's like Google. They have
Mhm.
SEO dominance. It's like LinkedIn, Google, SEO dominance, right? And no company has ever really been able to turn SEO dominance into an operationally intensive and successful business. My argument was that, like, when you look at the puts and takes of iBuying, it is this super frugal business, like a monkish business, right? You get like single digit gross profit margins. And at the end of the day, if you've done everything perfectly, you might eke out a few hundred basis points of net income. And so Opendoor was built with that DNA from day one. Zillow from day one was built with this like Google, Facebook type energy, right? Where we have 80
Mhm.
plus percentage points of gross profits to throw around and all these, impressive stock-based compensation plans and et cetera. It's not an operationally intensive company. And so it's one thing to say we can build an automated valuation model, which Zillow did. And it sounds like it was reasonably successful, right? Probably not Opendoor's level, but it did a decent enough job. The
Mhm.
problem is assuming that you can be an operationally intensive business. And that's something that like you really need to start from square one and build that DNA into your business if that's what you need to do to succeed. I think Zillow underestimated that and underinvested in it, and it allowed them to be overconfident at a time that they really should have been more cautious.
Yeah. And that, just to know back your point, it's like Google. Google dominates search. There's not no one even close, right? And so they thought they can just go in and build a phone, right? It didn't work out too well, and they couldn't get it done. Over many times, they had to work with partners, right? And eventually they figured it out, but they're still working very hard to catch up to the iPhone, right?
Yeah.
So, yeah, even if you are dominant in one, related area, like being the dominator of, home searches, doesn't mean you can just hop in and start to figure out how to get the right margins on flipping a house, right? Or what's it called? Selling a house and making sure that your estimates are correct, your risk assessments are correct. It's always funny when people say estimates and everyone laughs. Like I'm in these real estate groups, and whenever someone says, "I look at his estimates and my house is worth this much," people laugh now because Zillow shut down. But with Open Door Max, you can trust it because their business actually works, right? And so even if, again, just pie in the sky, they could eventually, if they were looking for more lines of business, they could offer this data as a business operation where they say, "Oh, you as a real estate investor, you can look at our data and you can pay us however much, whatever makes sense, and we'll show you our data that we're actually using to sell houses and buy houses." because it actually works. You don't have to rely on estimates, and that's very valuable. I look for real estate all the time, and I'm looking for some numbers on how much I can get this house for, and then of course what the comps are and how much I can eventually maybe do a cash out refinance for if I remodel and all this other stuff. And Open Door has all this data. They have all of it. The remodeling cost. They have the cost of the comps for the neighborhood, right? And they know how much you can again get the value up to and do a cash out refinance and get your money back by another one. So all of this data that Open Door is collecting is extremely valuable. Eventually, I'm sure they're going to tap into it. Um, just before we get into recession, I just want to get your quick thoughts on that.
Yeah. So in terms of the kind of proprietary
Yeah,
data
just the data. Yeah, all the data.
set.
How valuable is that?
Yeah. So I mean, I think it's hugely valuable. One of the things that I think people just don't really understand is every time that Open Door inspects a house, it's filming the house, right? It's collecting information like the sound in the area relative to the highway, right? What's the proximity to a Starbucks? How close are we to a golf course, right? And then it completely films the inside of the house. So now it has a 3D model of the house as well. And that adds up, right? Like that house is not going to get, for the most part, those houses don't get bulldozed and replaced. So now it has data about that home, about the inside, and that continues to add up. So I think, yeah, you can see in this chart, they have 375,000 home assessments. Those are distinct homes that they've assessed in the United
Yeah.
States. And so it's this growing data advantage because their algorithms have been fed by 375,000 in-person inspections, or at least videos. Right?
Mhm.
There are tangible data points that they're able to include, and
Yep.
through advances with computer vision, they're able to turn video data or picture data into actionable insights that they can use to inform their algorithms. I mean, it's super powerful, and when you compare it to the Zestimate, the issue is that like the Zestimate has a ton of data, sure, but it's not used. It's not the right type of data for what you need to run an iBuying business, right? Like the offer that Open Door gives you isn't the price that the home is right now. It's what they think the price is going to be in the amount of days they think they can sell it. And so all of these different metrics are being layered in from their proprietary data, the spot price of the home per their AVM, but also demand data and what they think that market is going to do in the near term. Zillow just didn't have all of that rigor put into their models. And so as a result, they're trying to use this estimate, but this estimate is like, one, the variance is a lot higher than Open Doors, but two, it's telling us a snapshot right now. And a
Mhm.
home isn't sold right now. It's sold in a few months. And if you can't read the future like that, you're going to really struggle in any periods of dynamic real estate movement, which is like 2020, 2021, 2022. That's all we know right now.
Mhm. Yeah, and that's a great segue into recession. So everyone's concerned about recession potential this year, later this year, or 2023, 2024, whenever interest rates are rising. What does all this mean for Open Door? Are interest rates favorable or detrimental, potential detrimental to interest rates rising, that is, to Open Door's business? And what happens in a recession? Open Door has not seen a recession yet, a big one at least, right? Maybe we've had tiny ones along the way, and someone argued that last year we maybe had dipped into a tiny one, but Open Door hasn't seen something like 2008 yet, or 2007, 2008, 2009. We haven't seen that. So how is Open Door preparing for that, and how that might that hurt investors or affect investors?
To be honest, this could be an entire topic in and of itself. There's so much that's misunderstood about this, which is great because there's a lot to learn. But I'd say at a high level, increases in interest rates are a negative. They're a headwind for Open Door because it increases their cost of capital. And since Open Door finances the majority of its home purchases with debt, that's a headwind. That said, you know, depending on the holding time, like a 1% rise in interest rates might impact a home sale 30 basis points, for example, so 0.3%. Open Door would just include that headwind into their offers for the home, so that it would be net neutral on an overall
Mhm.
basis. The other thing I'd say is that if we are in a recession, the Fed will probably lower rates, right? Like that's what they do during recessions. So there's not really a scenario I see where we're in a recession and interest rates are high. Um, That's just like sort of the dynamics that we would see in such a situation. Um, another part is that demand signals precede pricing signals by 3 months. And this is really important to internalize, right? Like when you think about real estate, if you put your home on the open market and you're not getting bites, you're going to decrease it over a period of weeks, right? Maybe every 2 weeks you decrease your home price by $10,000. But the actual demand signals precede that dramatically, right? You won't see those pricing signals until that home closes 2 or 3 months later. But the demand signals, which are how many people are going to a showing, how long is someone spending inside the house, how many mortgage applications are we seeing, right? All of these data points are owned and integrated into Opendoor's valuation models, into their engine. And so they know the demand signals far and ahead of changes in price. And so the reason this is important is, let's say that Opendoor is seeing that there's going to be a housing downturn. On the basis of demand signals alone, they can lever into selling homes more quickly, number one, but also they can post much more conservative offers when they acquire homes. So they're baking all of that into all of their offers every day. All of that macro is being fed into their offers. And so, and they guided in this Q1 earnings, they said, we think Q2 is going to be really strong, but then back half of the year, HPA is going to moderate. But the reason that this is important is everyone's been saying that, the only reason Opendoor is doing well is because HPA has been through the roof. It's just fundamentally not true. In a downturn, Opendoor would just give homeowners lower offers, and conversion would be higher because those homeowners need liquidity and they don't have any selling tools, right? They'll list their home in the market, but no one will buy it. And so in such a situation, Opendoor's product would bear much more value. And so conversion would be higher even with lower offers. And so that spread, which is not HPA, but it's spread between the offer and the current value of the home, is what's going to be driving gross profit margins in the back half of the year.
Thanks for walking through that. I do want to push back a little bit on the interest rates in recession. When we get into the recession, interest rates will be high, right? Which is how we get into the recession. So for some period there, won't we have high interest rates before the Fed has to turn that back down?
Yeah, I mean, potentially, but historically, what the Fed does is when the economy is super hot, they'll raise interest rates. When the economy slows down, they'll lower interest rates. If you look at what happened during 2008, 2009, interest rates went basically to zero or very close. Same thing happened during COVID. So I think there's not really a realistic scenario where interest rates are going to be high and we're in a recession. But the other thing too, I'd say, is the Great Financial Crisis is an anomaly of real estate prices. And outside of the Great Financial Crisis over the past 50 years, there's been 6 quarters where the HPA was negative 1% or more. I mean, that's a huge piece of data that we can use to sort of think about this, right? If Opendoor's exposure to a home is only, 70 days, and there's only been 6 quarters where home price appreciation has gone down by greater than 1%, I think that's pretty manageable for a company that's doing like 10 to 12 gross profit margins long term.
Yeah. And so they'll likely be fine.
Yeah.
Yeah. Thank you for walking us through that recession. Everyone's afraid right now about that, and of course, it's showing the stock price. It's down a lot because the whole market's down, and Opendoor is doing very well. But still, even though there was a big bounce after the earnings, people were very excited. We're still down considerably from where we've been in the last year, even let alone the all-time highs. So, how long do you think it will take for us to get close to those all-time highs, and how might the Q2 earnings play a role in that? Given, of course, even if they do well, and we are still seeing high interest rates from the Fed coming in, and more talks of recession, how might these Q2 guidance be received by the market? And of course, I would love to hear what those guidance are.
Yeah, so the guidance for Q2 is very similar to the guidance that they posted for Q1 in terms of revenue. The biggest difference is that they're guiding for about 5x rise in adjusted EBITDA from what they guided for Q1. And their guidance is pretty close to what they did for Q1. It's early days, but I can tell you, from the transaction data that I've seen so far, that they're probably going to beat those adjusted EBITDA estimates pretty handily.
Mhm.
One of the things that comes up a lot is, why is Opendoor guiding for a sequential decrease in revenue? And I think there's a lot of features of that. One is, Opendoor sold more homes than they intended to in Q1, and they discussed that on the conference call. They said that was about 300 million worth of extra homes that they expected to be in Q2 that actually occurred in Q1, and so that's part of the reason there was such a big beat. The other thing I'd say is, like we've talked about, Opendoor is very conservative regarding revenue, and so their guidance for low 4 billion revenue in Q2 is probably pretty conservative as well. I'll know more by the end of this month what the actual quarterly results will look like. But so far, it looks at least moderately slower than Q1. In regards to your question about stock price, I think all-time highs are sort of something that we have to forget about for the near term.
Mhm.
I don't see stocks returning to all-time highs in any sort of reasonably close period of time. I think for the long-term thesis of Opendoor to be embraced by the investment community, we need at least a flat or depreciating home price environment. And so if we see that in the latter half of this year and Opendoor is still able to maintain decent gross profit margins, conversion, net promoter score, and be at least close to break even, I think that that'll do a lot for the investment thesis. But that's sort of the big sticking point for a lot of people right now. They still believe, and I believe this is fundamentally flawed, but they believe that Opendoor will only do well if HPA is through the roof.
Mm.
I'm going to post some data on that soon because it's just false. Like Q1 homes sold, 2 of the 3 months, HPA was actually negative by cohort. So I'll post some of that data soon, but it's just something that I'm going to have to keep working on, and Opendoor is going to have to keep educating investors on, because it's just false.
Yeah. And like we always say on this channel, the short term, no one knows what's going to happen, right? It was doing great for a while there, and then it went down, despite the business continuing to grow and beat their estimates. We always say this on this channel: just focus on the long term, look at the fundamental numbers, look at how they're beating estimates, growing their revenues, growing their margins, adding more vertical integration, and yet the stock price continues to fall because people are afraid of whatever they hear from the analyst on CNBC talking about the macros. When we should be looking at it is the micro, where the how the company is doing in their markets, right, and with their products, and they're doing very well. So I I always say it's always about, where is the company going to go tomorrow, right? Are they making money today? Will they continue to make money tomorrow? Will they make more of it, right? Will they make more profits? How are they going to get there? And invest for that. So at these lows, these are great prices. If I had the money, continue to buy, right? Every paycheck, buy up. There's so much we can talk about here, and we've covered so much already. So I just want to close my notebook and, yeah, tell you thank you for hopping on this call with me. It's always fun to talk to you because you know so much about this company, and seems you have an answer to everything I throw at you, which is great. It's very helpful to investors out there watching, because people need a voice of reason, right? Of course, we can talk about the bull cases. You touched on some of the headwinds. Yeah, there's just always something to discuss with this company, right? And despite what we say here, people are still gonna be afraid of the market for now. But like I said, these are great prices. These are for a long-term investor. Of course, do your own research, read Tyler's articles, and look at Data Door, see how this company is performing, and make your own choices. Don't follow the whatever the analysts on CNBC say. So right? Because they always they're up and down. They're analysts, right? That's all they do. They say, oh, today is gonna go up, tomorrow is gonna go down, just buy and sell, right? But it's all about acquiring more shares cheaply. That's all it is. Before we head out, I just want to hear about any last words that you have.
Yeah, I think to your point, in these times where things are so uncertain and the stock market looks so bleak and every day can be double digit declines, and just to be in the market, you really have to have your conviction in what you're holding. When you look at what Wall Street analysts are trying to do, they're trying to price the stock, right? Like they're trying to be accurate about the stock. What they're not trying to do is be accurate about the business. And that's what I'm really focusing on with my research and with Datador, is to get the business right. Like you said, we have no way of knowing what's going to happen to the stock market. We don't know if there's going to be a recession or whatever is going to happen. But I think as long as the business continues to be doing as well as it has, and I think it's never been stronger, I'm going to be a happy, comforted shareholder who sleeps well at night. That's something that I'm excited to do. And so that's really the genesis of my research and what I'm trying to do with, what I publish, my content, and Datador.
Yeah, you say it right. Be happy and do your research and sleep well. It's pretty simple, right? You'll wake up in 5 years and say, "Oh, look at that! Opendoor is doing very well for me, despite all those ups and downs."
Yeah, ideally.
Yeah. So, yeah, of course, ideally, hopefully, right? Things can always go the opposite way. Then that's why we have to make some bets, right? You never know what's gonna happen, but if you don't try, you stay on the sidelines, you'll miss out on the ones that do work out. So, Tyler, where can people find you? Just real quick.
Yeah, so I'm on Twitter. I'm one of, I think, 2 Tyler Oklands in the world. So if you search there, you should be able to find me. Our website is www.datador.io. And there's links to that on my Twitter as well. And then I write a Substack called The Operator. So all of those are sort of the ways that you can find me. I love to hear feedback and ideas. Really like to interact with people. So if you have questions or you want a specific type of content or company looked at, just let me know.
That's all for our show. And if you're watching out there, if you enjoy this, let me know. Like and subscribe below. Comment your thoughts. If you agree or disagree, if you think what we said here was dumb, let us know. Be great feedback, right? Thank you again, Tyler, for being here. Really appreciate it. It's always great to talk to you, and it's very insightful. And we'll have to do it again. So looking forward to the next one.
Same. Thank you, Lincoln.
You have been watching bullacademy.org on YouTube, where we teach long-term investing by breaking down concepts and sharing the stories of companies to help you build long-lasting sustainable wealth. We hope you enjoyed this video, and if you did and want to see more like it, please remember to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts on this topic, even if you just want to say hi. Hi. I would love to hear from you, and I always do my best to respond to every comment. If you would like to engage with me outside of YouTube, feel free to follow me over on Instagram at Lincoln W. Daniel, where I share random thoughts on life and wealth building. As always, this video has been brought to you by our patrons at patreon.bullacademy.org, who support this channel financially to help us keep going and help me brainstorm new video ideas to share with all of you. We do the show together, and we do all of this in our private Discord chat, where we discuss the stock market in real time every day by sharing news, rumors, and new investment ideas, so we can all do our own research and then come back together and collaborate. So if you're interested in any of that, I hope you'll join us over at patreon.bullacademy.org. I'm Lincoln with bullacademy.org. Thank you again, and have a great day.